Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for February 2024. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. The aim today is to provide some insight into where we are currently in the global macro cycle and show how that is being driven by where we are currently in the global liquidity cycle. When we look at the updated data and how it impacts the specific macro assets, we'll then discuss gold, silver, Bitcoin, how all of them work together to provide an opportunity that you can take advantage of when you understand how these cycles work. So we've put together a panel today, and I'd like to welcome them here. We've got Paul, the director at Ainslie. We've got Joe, who's our head of research, coming on to help us out and talk about this. It's the first time we've done it this way. How are you going today, guys?
Very good, mate.
Chris.
So,
Thanks. Good to be
yeah,
here.
yeah, thank you for coming along. Now, as I said, the first time we've done it in this particular format, each month I've sort of come on and for the last few months talked about global liquidity specifically, but we've really stepped back over the last month and looked at how we could improve this format. And what we found is that people really enjoyed, we worked on that crypto one as well, which looked specifically at Bitcoin, but they really enjoyed that panel approach where we had multiple people where we could more talk about it. We just sort of trialed this last time, you and I, Joe, having a bit of a chat, but we really want to open up a little bit more broadly. So that's what we're attempting to do today. So we'll get in, we'll have a look, see how it goes. If you've got any feedback, make sure you reach out and give that to us on any of the social platforms, or you can reach out on X to me specifically at Tipper Analytics. But any of that feedback, most welcome. We've incorporated as much of the feedback, hopefully you'll see in this one as we can so far. But yeah, it's an ongoing process. So we really appreciate everyone's work on that. All right, let's get into it. But before we start, just a reminder with this analysis that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objective, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. All right, so a bit of an overview first, just before we kick into it. How are we going to approach this today? Where we are currently in the global macro cycle. So we're looking at really big picture at global macro, talking about growth, inflation, debt, and yields. Then we're going to dig into what I've usually been covering in the past, that global liquidity stuff, and look at where we are in that cycle. And then move from there into the specific macro axis that we're discussing, gold, silver, the gold-silver ratio, which is an interesting one. We've got Paul here specifically to talk about, and Bitcoin. Once we've done all that, we'll look at a plan that you can use to trade this yourself to take advantage of these cycles, and we'll open the floor to that Q&A as I suggested at the start. All right, so first things first, the big picture macro cycle. Where are we currently? And this is a chart that we've been quite excited about this last month. Joe, do you want to maybe start us off by giving us a bit of an overview of what this chart is showing? And then I'll get some feedback from you as well, Paul.
Yep. So we've got the four different cycles. We've got early, mid-cycle, late cycle, and bust. And in those four different cycles, there are different asset classes that you're going to want to invest in. So if you think back to October, late 2022, when we we're going through that bust phase, there were particular assets that outperformed during that time. And as we move, as the economic growth changes over time, liquidity changes, you'll see the cycles turn from bust to early cycle, which is what we're in now. We've had a little bit of a blip in mid-cycle, but we're back into early, which will dictate what our asset allocation is during that time.
Right. So if you think of this chart, look, we've got up here a circle going around, one part to the next. You're saying that effectively where we are in the cycle dictates what you want to invest in.
Yeah.
Obviously, up here, when we were at the mid-cycle up here, we were quite high on this scale. Like if you think about this being above the halfway and this being below the halfway, and now we're quite low. Does that mean that we are still, there's a long way to go left in this cycle? How does that work?
Yeah, so we've got some more slides coming after this one, which will point to us directly how early we still are in the cycle. Even though we're out of the bust phase, which is the ideal time, which is the bottom of the market for general risk assets, there's still opportunity in risk assets to make good money and good profit during the early cycle and also mid-cycle and late cycle before the bust.
Right. And Paul, obviously, director of the Ainslie Group, across a lot of this stuff, you're talking macro every day, you're talking gold, silver every day. Is this sort of reflecting what you would assume in terms of where we are currently in the cycle? Is this consistent with the news you've been looking at, the discussions you've been having, the analysis you've been doing?
Yeah, it certainly is. I mean, bottoms tend to be bumpy, and you can see that this is one of those bumpy bottoms as it's coming out of that sort of late 22 trough. And I guess it's there's competing narratives at the moment too. Will they, won't they drop rates and that sort of thing? And I think you'll speak more broadly as liquidity is well beyond the Fed. But the Fed is gaining a lot of traction, I guess, at the moment. So that bottom's a bit bumpy, but when you overlay it with the gold and silver price, you can see it's certainly turned.
So if we zoom in a little bit closer from this chart to look at what sort of makes up that chart when we're talking big picture macroeconomy, there's two elements to this, and that is growth and inflation. Now, I'll say right up from the start, we are looking at US growth and US inflation. Obviously, the United States is not the entire world. I get that. But it is kind of the place to start with this because the rest of the world tends to reflect what's going on and what we see happening in the US. So the first chart that we look at here is the ISM. Now, I've actually got two charts here on the ISM. So the white line, just to point out what's going on, the white line is the ISM number itself. The blue line, the light blue line over top, is the ISM new orders minus a 1 month lead. So you can ignore specifically what that is, but more importantly, it tends to lead, that blue line tends to lead the ISM by about a month. The second chart on the next screen has a different measure that tends to lead the ISM by about 3 months. So you can see consistently over time, and this is going right back for a long period of time, the white line tends to be led by the blue line. So I'm just going to go back to that 1 month lead to sort of show us what we expect to happen in the next sort of month ahead. And Joe, maybe can you start us off here explaining a little bit about what we're looking at here?
Yeah, so you touched on this is the US economy. This is US data, but we also need to remember the US is still the largest economy in the world. So it's going to have a significant impact on the rest of the world just by simple law of numbers. So here we've got, this is basically economic activity by purchasing managers, the top 300 purchasing managers. So anything under 50 is contraction in new orders, and everything over 50 is expansion. So as you can see, we're still in a contraction phase. We've actually spent
just under with that white line, isn't it? Just under that 50.
Just under, exactly right. So a lot of people have been calling for recession, but arguably the recession or the recession conditions have already passed. If you look at how long we actually spent in contraction underneath that 50, the previous most amount of time we spent in contraction would have been back to the GFC. So people are arguing for that recession. This is as a leading indicator, this is telling us we've already been in the recession and we're growing our way out of it.
That's a really interesting point, because what you're saying when you say under 50, if you actually look at that line through there, it spends most of its time not under 50, but when it does go under, it tends to go in a big spike. So is that maybe confusing people?
That's definitely confusing people.
Yeah, right.
100%. So if if you look historically, you've got 2000, which is a pretty clear bust, GFC, which is a pretty clear bust, and COVID, which is obviously a bust. So the fact that we spent so much time, but a shallower amount of time, on the index of the ISM is probably fooling people into thinking that they're really looking for that huge contraction to justify their bearishness.
So, Paul, do you think maybe that's a recency bias thing, or not recency, but is it just that our minds tend to fixate on the big events that have happened in our lives, and we forget that the majority of the time it doesn't actually look like these big spiky lows?
Yeah, I mean, generally, GDP growth, and it's always up and to the right. Okay, so you're generally above that 50 where the economy is expanding, and you've got to, I think, keep in mind too, markets are forward looking. So a lot of the talk about the recession, it was all being priced in previously, right? So, and we're seeing that now that you've got a definitive turn in both of those metrics, and the response in 2020 was so incredible in terms of the amount of liquidity that was injected into the system that I think there's a lag effect on that as well.
Absolutely, that makes a lot of sense. I think this is the number one thing that has caught people out this time, is expecting it to go lower. Looking at this chart, clearly 3 months out, we're expecting significant gains from here in the ISM if it follows the pattern that it consistently has followed since, you know, the 80s we're looking at there. Is that what you're expecting as well?
Yeah, and again, hence the fixation on whether the Fed's going to ease rates or not. I think people are looking through this recent past dip, and that they know what's coming, and that the market's responding.
Well, the market's certainly responding and believes that narrative. If you look at the Nasdaq, the S&P, they're all hitting all-time highs. So, you know, if you look at how the market's trading it, that tells you enough as it is.
Yeah, follow the money.
Yeah, and I definitely want to talk about that a little bit more as well, because that is a confusing point for me. But first, I'd like to dig into inflation. So if you look at growth as one side of the story, usually when you're looking at that big macro picture, it's growth and inflation. You need to sort of consider both. Again, looking at the US numbers, this chart I always find fascinating, the trueflation rate. Do you want to maybe give us an overview, Joe, of just what trueflation is, what the philosophy here is? Because the rate reported by the government last month, we were talking, or earlier this month, really, we were talking about a higher than expected surprise inflation number that came out of the US. But really, it's not reflected here. What's going on?
So the first thing is that what we've got, the trueflation rate is updated. It's probably more updated than what the Fed's backward-looking data is. The trueflation data would include lagging indicators such as owner's equivalent rent, which is one of the largest baskets in the service sector.
You're saying the Fed rates, all the numbers that they're using here to get the reported rate are lagging. Are you saying that the numbers here are lagging? Yeah.
Yes. Whereas trueflation is a real-time, up-to-date indicator of where inflation currently is. So with the Fed looking at lagging indicators with things that move slowly, it's only natural that they're going to have a higher reported rate of inflation. So you could use trueflation as a leading indicator of what the Fed's going to do, or what the Fed's going to report in the coming months.
So do you think, like, I actually am starting to think that maybe we're starting to bottom here, but that seems quite normal in a cycle to me, that we would expect to actually, as we move out of that early cycle into probably more of the mid-cycle, you'd actually expect inflation to pick up. Paul, do you think the economy can handle it if inflation picks up from here?
Well, I think part of the argument too is that the Fed need to, the risk of them easing is that they haven't got inflation under control, and when they ease, as they have to, and we'll talk about that more, they need to be, push this as far as they possibly can. So the trueflation is arguably, a truer indication of where things are at, and they're just trying to get as much out of it as they can before they inevitably turn. So I think that's a part of it as well.
That's an interesting sort of a little bit tinfoil hat argument of, is there manipulation at play to keep that number a little bit higher for longer? Because ultimately, when you're reporting something like inflation, you can pick and choose a little bit what measure of inflation you're using. And if you're using one that focuses on, to Joe's point before, focuses heavily on lagging components of the inflation number, then it's going to stay high for much longer. Whereas if you focus on something that's more real time, it's going to be lower. So is that at play perhaps?
Yeah, and to be fair, most of the flack they get is that they underreport it. Okay, so people are feeling in their wallets that things are worse than what they're reporting. So it's, there's very much two sides of this argument, but the trueflation is real data, so it's a bit hard to ignore it, and I guess there can be an emotive factor to the other side of it. On any look at this, they need to get this as low as they possibly can before they reverse. So,
and I think that leads us really well into what I wanted to look at next, which was this US government debt and yields. Now, this is something we were looking at a bit last month, Joe, and we've actually had a question on it as well, which I'll get you to refer to. But Paul, when you're saying they have to get it lower, or these rates effectively have to come lower, a lot of it is reflected in this chart, where particularly this line we're looking at US government debt hitting record after record. It seems every month we're hitting a new record. It really has gone that sort of hockey, hockey leg or hockey stick shape where it shoots off. And looking at that against the backdrop of the debt needing interest paid on it, we're getting into a bit of a tricky situation. Joe, this graph here, by the way, is looking at it over the last 30 years. We've got all the rates down the yields down the side as they currently stand across the different duration bonds, and the red line is the current funds rate. On the next chart, I'll just sort of show so we can see both. That's zoomed into the 5-year view. So the point was to show just how extraordinary this US government debt buildup has been. But on the closer view, starting to look at what's actually happening at the moment. Joe, can you maybe give a little bit of color around what's happening at the moment? And then we did have that question as well, if you could refer to that.
Yeah, no worries. So the first thing that we should take note of is that red line, the US government debt, and the fact that we have rates as high as they are meaning that to fund the government, they're spending $1 trillion a year just on interest expense. So that's $1 trillion of money that finds its way into the economy.
Which means in a year, this number is going to be, by definition, at least $1 trillion higher.
Well, they've got to print more debt to pay off the debt because they can't grow their way out of it. There's no growth. There's not enough growth to actually pay off the old debt, so it needs to be created to pay off the old debt. I'll skip through. This will probably answer a few of the questions we're already going to touch on. So we've got a question from Mr. Ahmed. He wanted to know, can you kindly show us various scenarios on how bond markets can affect the market? For example, who are the main bond buyers? If the banks don't buy bonds and Fed other government entity ends up buying most of the bond, how does that affect the market? So generally what happens is the Treasury, which is the government, will issue bonds at an auction, and the buyers of those bonds will be banks, institutions, and even foreign buyers. Generally speaking, it's fairly difficult to have a failed bond auction in terms of the US government having a failed bond auction, because the bonds will get bought. They just don't necessarily know that the price at which they get bought may just be pushed out. They might be a bit that the buyers may be demanding more interest for those bonds, which is actually potentially what's happening right in front of us now.
Because I was just going to make that point. So what we're actually looking at here is the yields, and they are inversely related to the price of bonds. So if we start seeing these yields going up, it means the price of the bonds is going down. And it's sort of economics 101 would tell you the price of something goes down because the demand is not there for it. So it's not, you're saying that people will buy the bonds one way or another, right? They'll get bought, but it just depends on what the price is. So if the price drops and these yields go much higher, it becomes more attractive for someone to buy them.
Yeah, and the market reacts to that. So the market watches these bond auctions, and depending on how well or not well they go, the market will actually move with that as well. So if the big institutions and the sovereign buyers don't want to buy them, then generally speaking, the rest of the market's not going to see that as a good sign, and they'll, you get those sell-offs like we have there.
And that becomes a bit of a self-fulfilling prophecy. So what my big concern is for this year, and I think I mentioned this at the start of the year, as the big almost black swan we need to watch out for, is that this red line has to come down. We've all identified that. Like Paul, you said that before. The rates, the Fed funds rate has to come down because the debt's too high, and for a raft of other reasons why at this stage of the cycle they need to start lowering rates. However, the pressure is going to be on if these yields continue to rise. And that's where we get into the scenario that might have been asked about in the question, where we end up with yield curve control or some form of quantitative easing or something where effectively the government's buying those bonds off itself. And then we end up in a bit of a potentially a Japan style situation. Paul, do you have any sort of insight or thoughts on that?
Well, I think part of what we have to look at when you zoom back, each time that we've been in a situation, history tells you what comes next. It's very clear there. You can't have a situation where your Fed fund rate is that far above your bond yields. And as Joey said, there's $1.1 trillion just in interest payments in the US now, so they cannot afford the Fed fund rates to stay up at that level. And then so there must be the alligator jaw has to shut, and as you're suggesting, logically, that's got to be the Fed funds rate comes down, not that the bond yields go up. But you've got this pressure of the, I guess, the de-dollarization and the lack of appetite in the market around these treasuries that are linked to the very same instrument that they're printing hand over fist. So there's a bit of a tug of war at the moment, and it'll be very interesting to see how it plays out.
I mean, I actually have an opinion on this of that it may not be a bad thing. And I mentioned this, sorry, I need to clarify that, may not be a bad thing for us when the sorts of assets that we're trading, which we'll get into in a minute. But because ultimately I'm wondering whether, if it goes up, we win. If it goes down, we win. Because if these yields were to roll over, it would be very normal, to your point that you just made, Paul. Like, you look back historically here, every single time it was the same story that played out. The argument is that maybe this time is different, and that we end up bouncing, these yields keep going up against this backdrop where they are having to lower. But then in that scenario, do they just step in? And I think, Joe, you'll probably have an opinion on this. Do they just step in and effectively buy up those bonds themselves to pin the rate there? That's more liquidity pumped into the system as well. So, do all roads lead to higher asset prices from here based on this chart alone?
Yeah, so I think no matter what happens there, we're going to see, so say the rates fall, or the Fed funds fall, that's going to help liquidity into the system. But if it goes the other way and you've got that sovereign debt crisis in the US, then that's a loss of faith in the system. So people are going to be looking for alternatives. If you remember back to March last year when we had the banking failures, Bitcoin didn't go down, it went up. So that's just a symptom of what's going on here. Particularly if they start to sell off, as in those interest rates go up.
A very good point. So what I think we might do is, just being conscious of time, I might move the discussion forward, which is really talking about the same thing, but moving it to the liquidity cycle, because that's an area that obviously I'm very interested in, that we believe drives everything that we've just seen. And I think it will tie in quite nicely. So I just want to start off with the liquidity cycle part of the discussion by looking at why we're even mentioning the liquidity cycle. And that's because if you look at this chart, and this has become one of my favorites to explain this over the last sort of month, global liquidity and world financial asset prices, you can see right back to the 70s, a very strong correlation going on. And this is talking about whether asset prices went up or down, that there was a link. Now, what's really important about this particular table is they use these causality tests, and the probability, it gets a little bit technical, but the probability that it was the asset prices causing global liquidity to move is effectively nothing, right? So it proves statistically, based on the data, that it was global liquidity that was causing financial prices to move. Now, that is a little bit different to how a lot of people think, because often people think, well, the sort of prices are driving the economy, when it's, they sometimes get this mixed around. This is showing very clearly that we can look to one source in particular to be behind the movement in prices that we see in world financial assets. So I think that's a really powerful place to start. And then from there, we look at this chart, which always fascinates me, that you can see very clearly when the liquidity cycle is high, or the index here is high. So when we're getting lots of liquidity pumped into the system, we get these asset price booms. And when there's liquidity being sucked out of the system, we get these banking crises. So it's a pretty compelling argument, and one that we've tended to focus a lot of our attention on recently. Do either of you have any sort of additional comments to make around why we're looking at this liquidity backdrop?
Oh, I think you go back to that previous one, Chris, you can see that correlation tightens more recently, right? So we're
Yes.
certainly getting into a financialized, hyper-financialized world where the stock market leads the economy. Like, so CEOs are making decisions based on their share price, and that share price is largely being led by this liquidity. So it goes sort of in reverse to what a lot of people believe. But what has happened is the amount and the magnitude of that liquidity has certainly been extended since the GFC, and we're seeing that even more so than we did beforehand. So it's gone sort of eyes rolled back. since GFC, where we've really seen, with the introduction of QE and these sorts of things, where it's just gone, a hyper financialized world.
And to your point there, that is 1 for 1 almost, isn't it? It's very tight.
Incredible, yeah. But they have been quite extraordinary amounts of liquidity.
Absolutely. And that's why, I mean, we'll make this argument on the next slide as well, that we're probably seeing, so this is really just a sine wave added over the top to indicate that this has been going on for a long time. But that, what you just explained, is why we're seeing it so tightly linked to this cycle. So where it might have been a bit vague in the past, it's, you can certainly see the cycle there, but it's becoming really highlighted and really exaggerated because exactly what you just said, that hyper financialization of it all. Joe, do you have any sort of extra on that?
Yeah, if you just flick back to that previous slide, so you can see exactly like Paul said, 2008 was the reset. Everything got reset back down to 0 interest rates. And you can see for the next 10 years or so, you got QE 2, 3, 4, 5, and that's basically where the Fed was trying to manage the economy by buying back bonds. We had the repo crisis and COVID, obviously, towards 2019 and 20 there. Everything where they could no longer manage it. Just basic QE wasn't going to manage the economy anymore. And ever since then, we've gone through even more wild swings just to keep the system running.
Absolutely.
And by swings, I mean more money being created.
Yes. And money created, like you touched on it before, Joey, it's money created just to pay the interest on all this debt. So this actually just keeps feeding on itself to a larger and larger extent. As you just said, during the GFC, we used to talk about there's only a few ways out of debt, and that's you either pay it off, and we're just consistently seeing this rise far greater than GDP. So that's just not even close to happening. You inflate it away, and we saw the impacts of just the amount of inflation that we've just had and what it's done to the system, or you forgive it or whatever. And what they've effectively done by bringing the cost of the debt down to 0 was almost I don't want to say jubilee, but they that was their only card left, and that is becoming increasingly the only card they've got left to play.
That doesn't work at 5% interest rates, though.
No. And that brings it back to your point before, doesn't it? That ultimately we have no choice here but for those rates to come lower for the sustainability of the system itself. But it's the pressures. We got the pressure, as we saw before, with those rising yields, because people are starting to lose a little bit of confidence in the underlying debt, and it's all self feeding.
So arguably the amplitude of that wave increases, right? And you touched on it before, Chris, that
yes,
you have these two scenarios where they lose control and the yields keep rising and they have to step in, or the rates come down and money goes back to zero cost.
But in either of those scenarios, that's why that it's a little bit sinister. But you sort of look at it and go, well, I seem to win in both of these scenarios with the types of assets we're talking about.
Yeah, it's perfect.
We don't want to say that because obviously it's not the best situation for everybody, but that's the reality.
Yeah. Well, the only option is to own assets, as we'll probably discuss later on.
Well, yes, and leading, just before we get to that, I just really want to highlight this chart because I really do love this chart. This comes from Cross Border Capital. Their sort of how they look at the market. If you go through down the list here on the side is basically all the countries in the world and what their central banks are doing in terms of green being injecting liquidity into the system and red being extracting liquidity from the system. And when you go back and look at this cycle that we've seen, you can see it's not isolated, right? Like this is when the world has become very much the one entity, as you can see in these charts, because they're all tied into this same system.
Yeah, I love that chart. It explains so well, just in one picture, how effectively central banks coordinate with each other to fix monetary policy.
Well, you could not deny there's some level of whether it's intentional or not, they're clearly all doing the same thing when all of the bars are green and all of the bars are red.
And they're all managing. They've got to manage their currencies at the same time. So that's why it's like that. You can't have someone tightening while someone's loosey goosey. The currencies would suffer.
Yeah, if it's not by collusion, it's by don't do it, your currency gets smacked. So yeah,
Well,
it's
and we've
forced
seen that
collision.
many times from the Australian perspective, haven't we, Paul? Like where you've just got often Australia sort of feels like it's trapped by what the US does because you have to follow suit or it's going to cost you one way or another.
Yeah, and then we've got our two masters of our biggest trade partner on the other side of it. So we're a little ping pong in between the two.
Absolutely. And the China data is certainly interesting to look at the moment because they are one of the big drivers of why we're starting to see at the end here it lightening up, starting to see a bit more green popping in or at least lighter yellows. And a lot of that is on the back of injections that China is needing to make to try and stabilize its economy where they've sort of gone too far into that or further down into that dangerous territory of sort of that late cycle bust type of environment.
Yeah. And you can see that you project Asia across that page. So that's where some of the darkest green is, right?
Yes,
so
absolutely. And that's all that middle, absolutely correct. Just the last little one to look at, because this is a great segue into what we discuss next, which is the specific assets and how they perform in this environment, is this chart, which talks about gold and crypto, which is an unusual combination there, which I'll explain in a second, but global liquidity and US CPI. And it's important to understand what each of these are. So this orange line is the gold and crypto line. What it really means is gold and Bitcoin. And what we're looking at here is that gold existed since the dawn of time. Bitcoin did not exist until about 2010. So what they've done is effectively looked back at these assets performing similarly. And since 2010, we've mixed in gold and Bitcoin together to get a chart reflecting the underlying black line here of global liquidity. So we see global liquidity since the 70s has been one direction up and to the right and increasingly so and projected so forward. And we've seen gold and crypto, or Bitcoin in this case, do its time-tested job of responding to that against this backdrop here of what's going on with CPI. There's actually a lot to unpack here, and probably Paul, I'd like your sort of perspective on it first, and then Joe, I'd like yours on it as well.
Yeah, everyone should print this out and put it on their bedroom wall. It speaks to a few things. So that, firstly, let's just see where this starts, right? 1975, so 2 years after we left the gold standard. And has happened all through history, is we're greedy and humans, and we inevitably go and debase that non-backed currency through credit expansion. And that's that black line up. So the other thing is people often talk about gold as an inflation hedge, and that's often confused with the inflation that the US CPI, and we've just spoken about even how that might be under or overstated, but it's still down the bottom there as you're showing, Chris. The true hedge is the monetary inflation, right? So, and that's what you can see very clearly that gold, and more recently gold and Bitcoin, are protecting people from. So the problem with that picture is that it then also brings in this social disorder that we're seeing play out in terms of the haves and have-nots, because generally your wage is linked to CPI. So your wage is going up by that little black dotted line down the bottom. But if you're holding gold and silver, then that's actually protecting you from all the the increased liquidity, which is just a proxy for a whole lot of credit that's entered the system since we left that gold standard. So it's a really important chart to understand because it really highlights the real inflation that you want to protect yourself from, and that's the monetary inflation, not the Main Street inflation.
And Joe, do you see this here on the back of what Paul's just said? He highlights that point about societal issues that we start to experience as this gap widens. Is this the wealth gap in action?
Certainly. I think people feel it. They can feel the wealth gap, but they can't necessarily explain why. Over time, people working full-time jobs, if they're able to afford their CPI basket, they're generally going to be not too bad over time. Like they're going to be fairly happy with that. But I suppose it also gets to the point where one wants to retire and you can't continue to work that 9 to 5. So you actually need financial assets to preserve your wealth. while you're going through that last period of your life. So that's where gold and crypto, well, specifically Bitcoin, when you get closer to those retirement years, you've actually built up enough wealth that you're going to be able to not just survive, but thrive.
A very valid point. And I think that's what people, and both of you have said it before, people feel it, but you can't see it. And here you can actually see it, right? That is showing you black and white the haves and the have-nots, right? Like the people who don't have the house and are just renting. To your point that you just made, you know, do you keep working? How do you afford the rent? Keeping up with that line when the prices of the things you're trying to rent are keeping up with this line. It's pretty simple maths that just does not add up to the average person who does not have financial assets.
And the line that's missing, Chris, is GDP. So if you actually track GDP against that, I think you'd find it pretty close to that CPI line. And
that's right.
And again, that just highlights this disconnect of reality of that we're leaning more and more into credit. And then ironically, we need more and more of it to pay for that credit. And so this just becomes an unsustainable, to use Jerome Powell's very own words, an unsustainable debt problem.
So we've preached enough doom and gloom on that note to look at maybe how we take advantage of this, because obviously in every doom loop, there's opportunity for those who understand how the doom loop's working and how to take advantage on the other side. So I've called this here macro assets for macro cycles, because I think that's a really interesting way, an important way to look at it. With everything we're talking about here is macro cycles, big picture stuff that's happening. You can't stop it. It's just the way the world is working. It's the way money is working. But if you have the right assets, you can take advantage of that. And we look at three in particular: gold, silver, and Bitcoin, with also the gold-silver ratio thrown in there for a bit of color around how that works. So they're all done in the same way. We'll start with gold, where we have this picture over the top. That's the sort of green to red line is our global liquidity cycle. You can see that reflecting what we've looked at before. In the background is the chart of the thing we're looking at. So in this case, gold over the last decade, so from 2014 through to where we are today. And looking at the correlation, you can see between the lows in the liquidity cycle, particularly lining up with the lows in the underlying gold cycle, as we've seen here, and the highs in the liquidity cycle lining up with the highs in the gold cycle. So the big picture gold one here is pretty clear that you can see that unfolding. I zoom in then on the next one, and this is the same for all these assets we're looking at, to look at it over 5 years, just on a slightly different chart to look at it so we can analyze a little bit more closely. So here we have gold over that 5-year period following up. You can see it almost one for one, following up the global liquidity cycle, where it peaked out at pretty much the same time, had a dip. I'll get Paul to explain this in a minute, what that sort of little anomaly was there, but really importantly, bottoming out at the bottom of the cycle. Now, people often get confused with this chart and say, well, it's where's the low? It should be right down there. It's like, well, that's actually it doing its job. It rebate the new low is at a higher low. That's what you would expect over time, because there's more liquidity in the system. You expect the price of gold to go up long term, and that to be the new base. But that's what we've seen happen here. It follow up, dip down, and bottom very nicely with the liquidity cycle. Did you have more to add on that for gold?
Yeah, no, it's an important point. One's an index and one's a spot price, right? So, and we just saw that graph of how it keeps going up and to the right generally. I guess the key point here is, what was that anomaly where it ignored that index, and that was Ukraine, quite simply. So gold has a number of drivers, and one of those is safe haven. And as you touched on before, Chris, there's two scenarios in those alligator jaws we saw before of bonds and Fed fund rate. If the bonds do go up, right, and we get this high rate unsustainable explosion, then you've got that safe play. If it comes down, then you've got the liquidity play. So gold has a couple of masters in that regard, but they're masters that generally protect you in various scenarios. So, but as you say, it very clearly bottomed pretty much exactly at the same time as that liquidity index bottom.
And it's fascinating it's held up so well.
Well, that was the point I was about to make. Well, like, if you actually look at it holding up, it's really holding up on the back of concern. It's kind of the same as the bond picture, isn't it? Really,
Yeah,
that it's
it's
holding
a
up our
sign.
concern.
And part of that safe haven play is, again, people reading the play. So absolutely, with interest rates where they've been, gold has no right to be above $2,000, okay? The reason it's done that is because the central banks, so don't do as they say, do as they do. The central banks have been backing up the truck and buying gold. And we just last week, Chris, we caught up with a gentleman from Singapore, a respected analyst, and I asked, why Singapore? They were one of the biggest buyers, and he said because even Singapore is looking at the weaponization of the US dollar, and yes, they're a close ally, and they're Singapore and neutral, but they're just saying, what if? So what if one day we can't move our US dollars around? So you get central banks moving out of US dollar reserves and putting it into gold, and that's been a huge move, and that, of course, drives the price up. And then you've got other people that are looking through the high interest rate, low gold narrative and saying, well, high interest rate and $34 trillion of debt, I'll take gold, thank you. So there's an element of people actually looking through that narrative, and that's what's holding this price up, I think.
And I'd just like to add to that, we can see even in that scenario where the price has been held up, it's still following the liquidity cycle. That's what I find so great about this. It doesn't matter on the absolute price following one for one. It's saying that even when there's that uncertainty, we generally can see that there's going to be pressure on the price of gold when this line is going down, and there's going to be support below the price of gold when this line is going up. So you can have everything you've just described working in the background that pushes the price higher, but you'll still see it ebb and flow with the underlying liquidity. And I think that's really powerful as a tool for us in analysing this.
And critically too, Chris, I was just, fell into that trap of we so often talk about the Fed and the US as and whether it's Fed or M2 or whatever it might be, they're only a part of the global liquidity puzzle.
Yes.
So and then, and as I've said, other central banks. So there's other liquidity coming into the system via, China and Japan and even ECB, and that's catching a bid. So we've got to stop this fixation of talking about the Fed and M2 and those sorts of metrics all the time.
That's right. This metric here that we're using is really, in my mind, second to none in reflecting what's actually going on across the world, because a lot of other people just do not analyze at that level. Now, I'm going to jump forward to silver, because this is one we haven't really looked at in the past, but it's going to certainly be looking at it closely going forward. The silver chart is actually very similar to the gold chart here. You might see the absolute low was here, but that was absolutely a COVID drop spike that happened. But if you were to ignore that, and I put that there to be intellectually honest, that's where the lowest point was. But when you actually look at it very clearly, it was bottoming out when the price was hitting its lows, and that was an anomaly. And then, sure enough, right up here at the highs, we rolled over again with silver price, and yet again picked the lows at the bottom of the liquidity cycle. So silver is another one that the global liquidity cycle is working very well for. When we zoom in here, though, what is this? Explain this situation.
That's silver, Chris. That's what silver does. Silver can test your patience, because what it tends to do, it's just it's a smaller market, and so it can it's more volatile. And let's remember too, silver wears two hats. It's it's half industrial metal, so it's used in solar panels and electronics and medical and all sorts of uses that are growing uses, but they're industrial uses, so they have economic drivers that way. And then the other half is monetary asset, so it doesn't behave like the pure monetary asset that gold is. And what that smaller market and that volatility means is it tends to just have lower lows and higher highs, and they tend to play out
explosive higher highs. Like that's a hell of a move.
Yeah, and it's such a lovely ride when you're on it. And the GSR, which we'll talk to soon, gives you the metrics to watch that. But it just has lower lows and higher highs, and it tends to take off as gold's going. And we saw that. So gold took off in 2020, and everyone's looking at silver saying, when are you going? And then it went, and it just blew past gold with vengeance. So
the point I'd find really interesting here is this can be a little bit tricky at a time, right? Like, so when we look here at the silver price at the moment pointing down, I mean, it's in a fairly tight range. I would hardly call that heading down. But if we've got this liquidity picture improving and silver sort of sitting here in this range, sort of bouncing around up and down, at some point, it'll do this again because that's what silver does, right?
Yeah, like it did exactly. I'm pointing to a screen you can't see, but it
well, that's
to the
it
left
here.
of that.
Yes,
So it did exactly that. So it's that's what it does.
What would be fascinating, another chart would actually to see that in Australian dollars as well, because we've seen the Australian dollar significantly devalue against the US dollar since the top of that spike there. So though we're looking at a move from around 10 to $27 there in US dollars, we peaked out from memory at around $41 Australian.
Oh, absolutely.
So the gains are actually
yes, yeah. And that's almost the point Paul made before. You've got to stop just looking in US dollars, but or looking just at the US. But the reality is everyone tends to quote the price in that. So that's the way we've done it here. But absolutely, to your point, it was just huge, and it compounds all of this when you start factoring in different currencies as well.
Yeah.
Paul mentioned it. We were also going to look at the gold silver ratio because it really highlights some of the things we're just talking about. The bit I want to talk about here, first of all, is that the gold silver ratio is very interesting because there's a very short distance between the peak and the bottom. So before we go any further on that, can you maybe just explain, Paul, what the gold silver ratio is for those who are uninitiated?
Yeah, sure. I mean, very simplistically, it's how many ounces of silver to buy an ounce of gold. So if you look over the last century, 100 years, it's probably averaged around 45 to 1. If some real gold bugs will go back to the oldie worldy times when it was 15 to 1, but some of that was king decrees and whatnot. Anecdotally, in the ground, it's about 15 to 1 as well. But if you take 45 to 1 as a rough average over the last 100 years, then it's that swing between the lows when silver's really, so if we look back to 2011, which is off this chart, we got down to 30 to 1.
Yes.
And right now we're sitting at almost 90. So when we were at 30 to 1, silver was about around $50. Okay. So that ratio just tracks, that they're generally a correlated asset, but whilst gold's sort of doing this, silver's doing this either side of it, but they're generally following the same path. Silver just has a bumpier ride, but if you play those bumps, they're a beautiful roller coaster.
Well, and this really highlights that point that you're making, because it's not so much that you would use the liquidity cycle like we do for gold and silver themselves here, but more that we would identify the time in the cycle that we see the GSR really outperforming. Here is actually the fall, right? That's silver outperforming. Yeah. So that crash there is silver rocketing that we were looking at on the other chart. And in fact, I'll go to the next chart to really highlight that. So where we saw that on the silver chart, it shooting up, that was this ratio collapsing lower. So there's some real patterns that you can identify. They're a little bit tricky to time. They're in fact quite tricky to time, but where silver is really the asset to hold in the cycle, because it just massively outperforms gold during that period of time. But the period of time doesn't last for that long.
No, you got to time it well.
And right now, to what you were saying before, we're heading up into that 90 range. We're certainly on the upside. So what is the strategy there? If you were just looking at it purely from a gold and silver perspective, would it be that you start this is you effectively try and start accumulating silver into that peak and try and switch back to gold at the lows? Is that generally how people do it, or?
Yeah, generally, and look, we even those up in the top right hand corner, you can see we've got our own gold and silver backed tokens. So CoinSpot, where they're listed, even have a GSR bundle, and we basically provide them metrics that tune the amount of gold or silver you might want to have in any one point in the market. Bringing it back to the physical here, it's the same thing. So when that's getting up high, that's when you're really starting to look pretty favorably at silver, because it'll revert. I mean, and I often say, if you believe in nothing else in this world than math and reversion of the mean, you've got a pretty well-established mean over time, and by any metric, even at 90, that
well,
one,
that's still 2 times, isn't it? 2 times your 45.
Yep. So it's pretty compelling.
Okay. Well, we've covered the hard metals that are clearly following this. Bitcoin is one that we're particularly interested in because it's very interesting against the backdrop of global liquidity. We've got this chart here, which I've referred to multiple times before, showing that of all the assets we're talking about today, Bitcoin is probably the most correlated to that global liquidity chart. So it's really a picture of the global liquidity chart, but also with adoption on top of that. And this chart just highlights that similar to what I was showing earlier in the world assets against global liquidity generally. But when we look at the same thing with Bitcoin cycles, the Bitcoin cycles are so large that this chart in the background is actually the logarithmic chart, whereas the others were just the normal sort of analog up and normally how you'd read a chart. These had to become a little bit more exponential, but that's really the benefit that Bitcoin provides here. We've got cycle lows lining up very nicely, cycle highs a little bit delayed, but again, when the price was kicking up, it was certainly there. And looking at it a bit closer, we've got that excellent correlation, what we saw recently with those lows lining up. Joe, did you really have anything you want to say about the Bitcoin correlation?
Yeah, obviously the peaks are going to be a little bit harder to pick. I've said this before, you'd rather be able to pick those bottoms, and when liquidity is low, you do have a fair bit of time to snap up those cheap assets like Bitcoin or gold when the prices are low. So I'd rather be good at picking the bottoms than being good at picking those tops, and just make the meter the move through the middle, make the profits through the meter that move, if that makes sense.
And we've had much more success. I know personally, at the bottoms, we find it's nice and relaxed. Not everyone's rushing to try and decide what to do. You've got some time to figure it out. At the tops, it's it can be very chaotic. So if you can get the bottom right, well, you'll be in a lot of profit. It's a good spot to be in when you have to make that decision at the top. Paul, did you have anything to add on the Bitcoin side of it?
I think it's really important to look at that scale. You touched on before with that log scale. Even if you had, and we often talk about, sort of DCAing out at the top. And so even if you had pulled the trigger at, when we were at the top of that green, and yes, obviously quite early, you'd made pretty good gains from the bottom, right?
I think we were down in the 3,000 or something, and it was up. Well, you would have at least tripled your money, probably 3 or 4 times your money on this little bump before it went crazy.
So it's and that's why it's just I said before, bottoms are bumpy, but tops can be pretty bumpy as well. So you don't want to be just jumping on that first indicator. You want to have a measured approach to exiting.
And to be honest, that's why we're doing what we're doing here, like going through and doing the full analysis, because you really do need the full analysis to be able to make all of this work, right? Like you can't just do it off any particular indicator.
Yeah, exactly.
So just a word from our sponsors. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Okay, so with that in mind, and everything we've talked about, we have a very simple trading plan. We want to provide value here for everyone. So a simple trading plan of how you could take advantage of these cycles. And it really is simple. It's just buy low, sell high. Who would have thought that would be a trading plan that would work? But anyway, what we look for is when that global liquidity index data tells us that we're near that low of the global liquidity cycle, we look for a signal then to buy, and we hold that Bitcoin until we build up conviction that we've passed that high in the cycle, and then it's time to sell. And that is exactly what this chart is showing. So global liquidity cycle hit its low in October 2022. We were confident of that and ready to buy during this period of time. We waited for a signal to sort of, which will be a number of factors that come together to say, right, today's the day we're going to go, yep, put the buy in. We did that on January the 10th, 2023. And as you can see, this chart was updated this morning. we've been doing very well since then. In fact, we bought at 17,179 US, and we are now 51,732. So that's over 200% in 412 days, which is 178% annualized. Those numbers are just extraordinary and really cannot be matched anywhere else, can they?
No, it might be worth putting up the tweet as well, Chris. So for those doubters, I remember you put that tweet out that day, and since we've been following our current strategy, and so there's no way to say you just made that number up either.
No, that's definitely a real number, and we definitely have been and will continue to trade that right through. But I think it really brings together everything we've talked about, that to think about that and say, well, those numbers are extraordinary, but we've been saying this whole presentation, we still think we're in the early cycle, right from the very beginning, we've been saying that. So it's a tricky one. A lot of people on those sort of gains where you've made considerable amount of money on any other trade, you'd be very happy with that, would be going, I want to take my profit here, but we're not there yet, are we, guys?
No, we're not even at the previous all-time high. So it's
sorry, Paul, you finished, mate?
No, you're right.
I was just going to say, so if you are looking to sell, I suppose you've always got to look at what the alternative that you're selling it for. So every time you sell something, you're buying something else. So if you're selling your Bitcoin or your gold or your silver, you're buying dollars. And the only thing that's 100% in the world right now is that those dollars are going to be debased. So the last thing you want to be doing is being left behind, holding your dollars while the government intentionally debases the value of them to pay off the old debt.
Absolutely. That's a struggle everyone will face. Like, it's actually a very real struggle of what you do when you make those gains. If you go and put it into the asset that is being debased, then that's scary in itself, right? It changes your mindset. You go, well, I don't want to be in that dirty fiat anymore when I don't trust what's going on there. So it's a very tricky one.
Yeah.
We've actually gone a little bit over, but we're still within the hour so far. So we do want to open the floor to questions. And I know that Isaac here, who joined us on the crypto podcast, he has a question that he wanted to ask here. So welcome and thank you for your work on that crypto one, Joe. Isaac, everyone appreciated that. So welcome here today.
Yeah. It was a pleasure making it. I loved it. All right, guys. So I just got a question for the whole panel here. It's relating to the US debt. So just going over what you guys said, by the sounds of it, it seems like the Fed has no real way to control the debt burdens, especially as they're growing at such a fast pace now. So what do you guys think in the future going forward? How does the Fed solve this issue? Because it doesn't seem like there's any reasonable solution. And especially going forward, you got to think about the future generations. How are they ever going to, afford houses and these types of things? So I just want to hear your guys' thoughts on that.
Well, I want to start off there because I'm terrified. I'm terrified that they can't solve it. I genuinely believe we passed the point of no return somewhere on this line, but earlier than where we are now, where it can only, it's like if you have too much debt to get another loan to pay off the interest of the first loan, it spirals to infinity. That's where I think we are. I don't think it's a tomorrow. I don't think it happens tomorrow, but I think we're on that path over the next probably 50 years, who knows, maybe shorter than that, where there's not a lot of hope for the debt situation unless we solve it through something else. And Joe might have an answer on this, or Paul, through really a fundamental change to how the economy operates.
Well, the only way I can really see it being solved at the moment is you have to increase productivity gains. So that can be done either through AI, robotics, some new form of energy that would allow economic growth without the government having to stimulate that growth. That's the only way you'd be able to actually grow your way out of it, is people become more productive. For any particular single country, it might be mass immigration, which is not a popular way to do it either. So it's a rock and a hard place, really, for each government.
I mean, I said earlier, don't do as they say, do as they do. But Jerome Powell's the head of the Fed, and he said before Congress, I think it was quite recently, that it's unsustainable. He outright said the US fiscal situation is unsustainable. So he's imploring them to fix that. I don't know that they can. As we said, it's exceeding the defence budget. It's starting to nudge up towards Social Security and Medicare, and we're looking at that chart. If those yields or rates do stay high or go higher, then it's hard to see how they escape it. And even the AI piece, then that's inevitably going to come with some form of mass job losses as well. It might increase productivity in the number, but so you're then into universal basic income or something like that. That's then just going to take that social number even higher. So it's pretty hard. I mean, and I touched on it before. You get those societal issues that we spoke about before when you get that gap between the CPI and the monetary inflation we saw earlier. Without being gold bug and all this sort of thing. Ray Dalio, the head of the biggest hedge fund in the world, wrote a really insightful piece on LinkedIn probably a couple of years ago now, where we see this time and time again through empires fail, right? So are we at that point? That's pretty extreme, but when you've got someone of Dalio's ilk to suggest that we're getting close to that point, then you've got to start to listen. But I don't have a solution, and no one does, and no one is incentivized to, because we're on 4 or 5 year election cycles. So you just watch expenditure this year in an election year. The problem is no one's got the long-term need to fix it.
The only really solution, like we talk about solutions, the only solution is to own assets to protect yourself against the debasement.
Yes.
Personally own the assets. And Isaac touched on housing affordability. I think we're going to see more and more people, younger people, as they're priced out of the market and high barrier to entry with stamp duty and all those sorts of things and deposit requirements. They're going to move more towards assets, self-custody assets like Bitcoin and gold to protect themselves, because it's a lower barrier to entry and the gains are going to outperform the property market more than likely.
Yeah, actually, thanks for that, guys. That really helped me understand that. And especially considering what's going to happen, Bitcoin and those type of asset classes, they're going to be especially as a young person, probably the best sort of assets to own. Especially because it's portion based, you can acquire a little bit, unlike a house. I've got one more question. I was seeing you guys think about this one. So I've also noticed, I was looking at a chart before, the S&P 500, when the Fed does the rate cuts, I've noticed that, let me pull the chart up. It was like since the 1970s, every time there's been a decent rate cut, the S&P 500 has actually like fallen like a decent amount. So is this due to the fact that rate cuts already priced in, and then the market, they do a bit of a sell-off due to the fears of economic slowdown? Is that what it potentially is?
I would say it's usually almost the other way around. It's usually the Fed been delaying the rate cuts until after the economy was already rolling over. So, and we've said right through this that the markets tend to try and front run what's going on. So if they see things are looking pretty bad for the economy, the share market takes a bit of a nosedive. So I think what you're probably seeing, Joe would probably have a better grasp of this than I do, but I think what you're probably seeing in those charts, not looking at it, is that the share market is effectively front running the problems in the real economy, and the Fed is cutting rates to deal with those problems in the real economy. Joe, is that what you would interpret it as?
Yeah, so the Fed's just been reactive instead of proactive. So I pretty much agree with what you're saying there.
But I'd love to, and I'm speaking without knowing the answer here, but I'd love to see a more contemporary version of that, because absolutely in the past, they've always been too late to cut and too late to turn. So, but nowadays, I think people are starting, because of this hyper-financialization and because we kind of know the new playbook since the GFC, is that drop in rates is just the market going, giddy up, here comes the free money. So in the past, absolutely, drop in rates was always lockstep with a recession, and hence the markets would be coming down at that time. But I just wonder now whether there's more front running because we know what it means.
Well, I'd love to add a point on that. Whoever, and I wish was it Yellen who said we'll never see another recession in our lifetimes?
Yeah.
Was that?
Yep. Yeah.
And we all laughed, right? And said, "That what are you talking about? Of course we'll see another recession in our lifetimes." Well, we may have just been through the first of this never another recession in our lifetimes, right?
Yep.
It might be a bit of a stretch, but we pointed that out right at the very start. And I'll actually just bring that chart up just to really highlight it, where we saw this period down where people were going, well, it was actually on the ISM. We were in this cycle here. And from our perspective, when we're looking at it, we're going, oh, yeah, that's a cycle. That's a bust. We're there. We're at the cycle low. It's right down the bottom. Everything lines up. No one believed it because it only just dipped below 50. Where's the big crash they were expecting? We made this point earlier. So was that maybe the first of this, never see a recession again in our lifetime? Maybe that was the case.
It's only a recession if they call it a recession.
Well, and
that
is actually, I mean, you're being a bit facetious, but that is a valid point because the definition of that sort of changed a bit. There was a lot going on there.
Oh, and you touched on it earlier, Joey. You just import, in Australia's case, 600,000 people, and you've just got a whole lot of consumers. So you're absolutely in a per capita recession, but you just keep importing bums on seats and you never have a recession.
Yep, 100%.
Oh, thanks, guys, for that. Appreciate your responses there.
Well, thanks for the question.
Thanks, Isaac.
All right. Are there any more questions? I don't see any more hands up. So on that note, we're just a little bit over time, but not too much actually. So thanks everyone for watching our update for the month. Thanks to Joey and Paul and for our live audience, for Isaac for asking that question. Hopefully everyone finds it valuable to step through the process in this format. Like I said at the start, we're playing around with this, trying to make it a little bit more engaging because we really do need to keep on top of it every month. We feel that, obviously as an audience, you need to keep on top of this every month as well. So we'll try and keep discussing more of those questions are great. It allows us to focus on what you want to focus on. If you've got any feedback, give it to us via any of those social platforms. This will be up on YouTube. You can reach out to me on X at Tipper Analytics. Any of those platforms, we'll see what you're saying and endeavor to include that next time. So any final thoughts before we finally wrap up? Joe, Paul?
No, I think we covered most of it. Well covered.
Yep, we've got it all covered. All right, like I said, reach out if you've got any of those questions. If there's anything you want to ask any of us specifically, we'll be certainly back here next month to do the March update, reassess, identify what's changed. Until we chat again, good luck in the market, everyone.
Thanks, guys. See ya.